Our next speaker is Kristian Fors with the Independent Institute. Welcome, Kristian.
Hello, everybody. My name is Kristian Fors, and I'm a research fellow at the Independent Institute, where my research focuses on public policy and economics, with a specific emphasis on government waste in California. So it's a pleasure to be with you today, but at the same time, I wish that I didn't have to be with you today. I wish that we had a state in which the insurance regulatory system was functional, eliminating the need for this conference to begin with, but unfortunately, we do not live in such a world, and hence we have this presentation. So I'm the author of the recently published policy report, How California's Homeowners Insurance homeowners insurance market collapsed and how to fix it. And as previously mentioned, many of the major insurers in the state, 7 out of the top 10, have paused or restricted new business. The FAIR Plan, California's insurer of last resort, is being overwhelmed. More and more people, especially in the high-risk areas, are moving to the FAIR Plan. The policyholder surplus of State Farm General, the largest insurer in the state, has declined from $4 billion in 2016 to a mere $1 billion. And Proposition 103, which I'm going to get into, is a very complex and multifaceted issue. Usually when you're discussing a logical argument, you can go from A to B to C. The problem with Proposition 103 is the way I want you to imagine it is it's almost like a river that goes into an ocean. So the river goes into the ocean, and it's not A to B to C. It's all of a sudden all these things are affecting the insurance market at the same time. You have the regulatory rate suppression. You have the wait times. You have the delays. You have the fact that you cannot raise your rates more than 6.9% without a hearing. So this is a very multifaceted issue. So I'm going to take it slowly and go over all the variables that created the mess that we have in California. So going back to the issue in California, between 2012 and 2021, the average underwriting profit in California was negative 13% compared to the national average of 1% over a, what would that be? Over a 9-year period. So to talk about what the insurance companies have done, their actions are listed on this document, which may be a little bit hard to read, but you can see that the stated reasons for leaving for many of these major insurance companies, USAA, expected rate inadequacy, Chubb, inability to achieve adequate price for the risk and not by a small amount, State Farm General, the largest insurer, rapidly growing catastrophe exposure, construction costs outpacing inflation, and a challenging reinsurance market. So when you look at all these companies combined, as Carl mentioned, his bookshelf is empty. Many of the major companies have left, and Californians are running out of options. I remember reading an article, I think it was for ABC, where they were interviewing some people who had lost coverage due to insurance, and they said the problem in California is not of pricing, it's of availability. So when there's no options left, consumers become like a lot more logical. They think, wait a minute, what is insurance? Maybe there's something going on, because otherwise, like, I have money, I'm willing to pay, why can I not get it? And there's a reason for it, and as we know, the reason is Proposition 103. So going back to the FAIR Plan, the number of FAIR policies has doubled. The numbers of FAIR Plan policies for residential properties has, since 2020 to 2024, has more than doubled. The percentage of FAIR Plan policies relative to total residential insurance policies has grown year over year, and it'll probably continue to grow. And as Carl mentioned, the FAIR Plan is not subject to Proposition 103, and their premiums are much, much higher than what the average premium in the state is. I believe the FAIR Plan probably costs $4,000 to $5,000 per year, and a lot of that is only for wildfire coverage. This is especially true at the top 10 counties with wildfire risk, as you can imagine, where the insurance companies have been forced to withdraw from. And the plan's losses from the LA wildfires have already been substantial. And according to California law, insurance companies, licensures in the state, are responsible for FAIR Plan losses. So there has already been a $1 billion assessment from FAIR Plan losses, and these losses are going to be passed on to the average consumer. So going back to Prop 103, why was Proposition 103 passed? That's something that people have asked me. They assume that, oh, there must have been a good reason to implement this, otherwise voters wouldn't have voted for it. The first thing is, I don't want to call it political bribery, but as mentioned earlier, it was a 20% reduction in then auto rates. So if voters see that they're going to get a 20% discount, of course they're going to vote for something. It's in consumer self-interest. But more importantly, when I read through the voter guide for Proposition 103, the primary overwhelming emphasis was on auto insurance. So when you look at all the discussions, you can see, keep big government out of the auto insurance business. I think is this the one by Harvey? No. But you can see drunk drivers, they're all talking about drivers. The proposition, of course, did mention property and casualty insurance, but it was really a side note. So as mentioned previously, I do not think when voters implemented Proposition 103 that they would ever expect the magnitude of consequences that we've experienced today. And by the way, the proposition passed with a very narrow margin. Only 51% of people approved it. So when only 51% of people support something that perhaps they don't even understand the full consequences of, and years later, it has absolutely wrecked an entire industry, you have a serious problem on your hands. So critical historical context, as I mentioned, it was primarily sold as an auto initiative. The author of Proposition 103, Harvey Rosenfield, has benefited, I won't say profited because Consumer Watchdog, the consumer advocacy organization, is a nonprofit, has benefited immensely from Proposition 103, which effectively created a niche sort of law through consumer intervention. And a 2024 LA Times article reveals that in the decade prior to the article, Consumer Watchdog collected more than $11 million in consumer intervention fees because one of the things that Proposition 103 does is that it allows consumers and their representatives to challenge rate filings and to recover fees and expenses. So Harvey Rosenfield, the author of this proposition, ends up working in the exact sort of law that he created, which is effectively creating your own niche, boutique sort of law industry. So yes, as I mentioned, Proposition 103 is very multifaceted, so please bear with me. But what it essentially does is, the first thing it does is it creates a prior approval system. When an insurance company wants to raise rates, they need to file with the insurance commissioner, the Department of Insurance, and these rates need to be approved before they're allowed to be implemented. The regulation that governs this is that rates must not be excessive, inadequate, or unfairly discriminatory, which sounds reasonable on paper, of course, right? But the truth is that Proposition 103 subjects California rates to a litany of other regulation on what exactly it means to be excessive, inadequate, or unfairly discriminatory. So for example, in 2019, California banned the use of gender as an auto rating factor in auto insurance, meaning that you're not allowed to charge males more than females. And I'm sure that every male in the room will tell you that when you were 16 years old, 17 years old, you were probably a reckless driver. I know that over the past 10 years, my driving habits have certainly changed. So the truth is, the basic truth of economics is that there's no such thing as a free lunch. So when you exclude the use of relevant variables, someone has to pay for it. So in the example of California, what happened is when they banned gender as an auto rating factor, women ended up paying more and males ended up paying less, but it was approximately the same amount of money. So the bad behavior of males in driving was directly compensated for their female counterparts. So as I mentioned, it allows it created the consumer intervener process where consumers and their advocacy groups, like Consumer Watchdog supposedly, are allowed to challenge rates and recover fees. It allows the insurance commissioner to challenge rate filings via hearing. Hearings are also triggered when rates exceed 6.9%. And I was curious because that 6.9% does not seem like a lot in an inflationary environment. I was curious, how burdensome are hearings on insurance companies? So I reached out to the Ombudsman of the Department of Insurance. The Ombudsman informed me that in the past decade, probably prior to the State Farm hearing recently, there had only been one hearing. So hearings are such a regulatory burden that companies will do everything in their power to avoid hearings. So this 6.9% is effectively a legal cap on the amount which insurance companies are able to raise their rates by. As I mentioned, it subjects insurance rates to a litany of other regulations which are found in Title 10, Chapter 5 of the California Code of Regulations. So going to the rate inadequacy that we're experiencing in the state. Insurance markets function properly when insurers are allowed to charge a premium that directly reflects their long-term expected average costs plus a normal rate of return on capital for the shareholders or policyholders, depending on whether it's a for-profit or not or mutual insurance company. Regulatory rate suppression, on the other hand, is the difference between these rates that are actuarially sound, those that are priced in accordance with risk and real expected cost. According to research by the International Center for Law and Economics, California has the worst regulatory rate suppression in the nation for both home and auto insurance, the worst in the entire nation. Even though we're the largest residential insurance market, we have the worst rate suppression. So on one hand, as Carl mentioned, if people had the ability to do business in California, they would love to do so. There are so many consumers here. It is ripe for opportunity, but we have the worst regulatory rate suppression in the nation. According to the president of the FAIR Plan, which is not subject to Proposition 103, but is still subject for department rate approval, the plan had a rate need of 70% in 2022. They didn't think that was realistic. They didn't think they were going to get it. So they instead applied for a rate change of 48.8%. They were ultimately only approved for a 15.7% rate increase. So what is that? That's about a fifth of the actuarial rate need that they had at the time. And if these are the rates that are being approved for the FAIR Plan, you can only imagine how actual other licensed insurance companies are faring. And the recent emergency rate hike the State Farm was recently approved for is proof that there's rate inadequacy in the state. The fact that even the department concedes that California's in a crisis and there's a need for emergency rate increases, that is a confession that our system is flawed. So yes, breaking down the cause, as I mentioned, you cannot raise rates more than 6.9% without a hearing, which implements an effective legal cap. According to the California Department of Insurance, 60% of rate filings from 2017 to 2020 were between 0 and 6%, as you can imagine. One company, just to avoid a hearing, even filed 6 separate 6.9% rate increases in a 23-month period. And by the way, to talk about regulatory rate suppression, one of the things about California is not only can you only raise your rates by 6.9%, you're only allowed to do so. You're not allowed to request another rate increase while one is still pending. So on a normal like homeowners policy line, you're allowed to do 6.9%, wait for approval, 6.9%, 6.9%. So you can imagine in an inflationary environment, when costs are raging, when wildfire risk is surging, that this 6.9% rate increase at a time, especially when you're forced to wait, the average wait time for rate filing decisions between 2017 and 2020 was 160 days for non-intervened filings. This means theoretically the department's okay with it. They're not going to challenge it. And 337 days for intervened filings. So when you're forced to wait that extensive amount of time, months, just to raise it by 6.9%, you can imagine that over time, the difference between reality, what rates should be, and the rates that are permitted by regulators is going to become increasingly far. So under Proposition 103, rates are supposed to be deemed approved if they are not challenged by the department within 60 days of an application's notice. The reality is, as I mentioned, companies will do everything in their power to avoid a rate hearing. That means that the department has significant leverage to delay. So the deemer clause, the clause that deems rates approved within 60 days has been rendered moot because the Department of Insurance can just use the leverage that they have to request the companies waive the deemer date. And if companies do not comply, they can move to the department can move them to a hearing, which is just going to cause even more regulatory lag and rate suppression. So another issue, as I mentioned, Proposition 103 subjects California rates to a litany of regulations. Two of the most impactful were the restrictions on forward-looking catastrophe models and reinsurance costs. So forward-looking catastrophe models are essentially models that take probabilistic approaches to how wildfire risk might evolve into the future. And it's ironic that California, which claims to be a progressive state that emphasizes policies around climate change and other Gavin Newsom initiatives, it's ironic that a forward-looking state like California has an incredibly regressive approach when it comes to our approach to catastrophe modeling insurance. And reinsurance costs, which are effectively which is effectively insurance for insurance companies. So when you have a huge loss event like the ones in Los Angeles, when there are thousands of structures that have been destroyed in an incredibly expensive area, companies want to prepare for that liability, and they will purchase reinsurance to prepare for massive catastrophe events like this. Previously, according to California regulations, factoring reinsurance costs into rates was prohibited, even though in a catastrophe-ridden state like California, this is an absolutely essential, crucial part of the insurance equation. Same with catastrophe modeling. So to illustrate why this is a problem about catastrophe modeling, in 2023, USAA gave different California counties a wildfire risk score threshold from 1 to 32 and said that they will only accept new policies with in areas that have a score of 1. Not a single place in California, not a single county had a score below 12. So this perfectly illustrates the economics of insurance. If you force companies to exclude relevant variables from their risk calculations, they will simply opt out of the market altogether. Oh, yes. So when insurers are prevented from setting actuarially sound rates, incorporating all relevant risk variables, and are forced to wait months to raise their rates, often only by 6.9%, the maximum amount without a rate hearing, they cannot respond effectively to changing conditions. Among increasing wildfire risk, increasing inflation, increasing construction costs, which have outpaced inflation, by the way, eventually this is going to lead to a situation where insurers flee the state. So speaking about wildfire risk, there are two aspects to an insurance market. There are the premiums, the written premiums, and there's the underlying risk. And to solve the situation, you really need to rectify both. But I've talked about the premiums. Let's talk about the risk for a second. So wildfire risk in California over the last 2 decades has increased significantly. Even before the recent wildfires in Los Angeles, which have been incredibly destructive, we don't really even know where they rank in terms of their destructiveness now. 9 out of the top 10 biggest fires in California history have occurred since 2017. If you look at the total amount of acres that are burned per year, it's more than doubled in the last 2 decades. And while the total number of fires has decreased, the average amount of acres burned per fire has gone up significantly, which means that when wildfires in California burn, they're burning more destructively than ever before, which is going to be a problem in places like Los Angeles. And as Carl mentioned, I'm from Los Angeles. It was stunning to see the fact that these fires were at 0% containment for so long. It's like, if you can't contain these fires, they're just going to keep spreading and burning more and more. So wildfire risk has increased significantly, and insurance rates need to account for that. Oh, and also speaking about costs and loss with regards to wildfires, the average loss from 1999 to 2008 was $400 million, and this is inflation adjusted in 2018 dollars, versus 2009 to 2018, the average figure was more than $1 billion per year. So it's more than doubled. So another question is that people have asked me is, why were so few homes in Los Angeles fire resistant? You would think that people who live in such a risky area would take every effort to protect their property, their life, and everything that they hold dear to them. But the truth is that if you look at Palisades, I mean, a lot of people had dry brush in their yard. Things were not particularly fire resistant. And one of the reasons for this is the fact that we have inadequate rates in California. So when people are not paying in accordance to the risk that they are exposing insurers to, they have no incentive to implement good practices on their own property. So as Carl mentioned, right now, according to LAR's regulation, there are minimal discounts if you take certain measures like putting on a fireproof roof onto your home or doing other things. But the truth is that the reason why insurers are not incentivized to give good discounts is because rates are already unsound to begin with. So if you're already not receiving enough premiums relative to the total risk that you're exposed to, of course you're not going to give one person a discount because your entire insurance model is broken. But you can imagine in a system, a free market system where rates are adequate relative to risk, that insurers would say, oh wow, you've taken all these steps. if I don't offer you a discount, my competitor is. And this is one of the most important things to understand about the insurance market. Insurance is a homogeneous good in which there is competition. Insurers primarily compete with each other on the grounds of price, and if you can prove that you are a less risky client, your competitor will see that as an opportunity to take your business away if you do not offer that person a discount. So in a free market system, people living in the risky areas, if they want homeowners insurance, they would be forced to pay for that. And if they implement good practices, they would receive discounts. Policy recommendations. So ironically, Laura, the current California Insurance Commissioner, captured the essence of the issue in 2024 when he said that by law, the insurance companies don't have to be here. And when we overregulate, we'll see what happened after the Northridge earthquake. When the legislature came and tried to overregulate, they no longer write earthquake insurance in California. When he said this, he captured the essence of one of the most famous quotes in all of economic philosophy, that it is not from the benevolence of the butcher, the brewer, the baker that we expect our dinner, but from their regard to their own self-interests. Insurance companies are companies. They do not provide, mutual insurance companies are a little bit different, but typically, insurance companies provide their services for profit, and when you take that motivation away, it is not surprising that they will leave the state in droves. So what needs to be done? The prior approval system needs to be abolished, and premiums should be set in accordance to the dynamics and principles of a well-functioning, open competition insurance market. Unfortunately, due to the fact that in the language of Proposition 103, it says that the proposition cannot be amended except to further its purposes, Proposition 103 must be put as a ballot initiative for voters to repeal. Insurance companies should be able to raise and lower their prices freely in accordance with ever-changing conditions, and they should be able to incorporate any risks that they consider relevant in their actuarial assessments. And by the way, as mentioned previously, if they incorporate variables that people don't agree are actually relevant, the consumer might know better than the companies, and they can go to the competition and say, hey, I actually don't think this is